Welcome, everybody, to our panel. Let's just start firstly with 10-second intros. Fadi, will begin with you.
So my name is Fadi Arbid. I'm the CIO and founding partner of Amwal Capital Partner. It's a long bias, long short MENA hedge fund.
Mohammed?
Yeah, good afternoon, everyone. My name is Mohammed and Jamal. I head public markets at Waha Capital. We run primarily two strategies. One is an absolute return strategy that focuses on the MENA market, on the equity side. And the other one is a global emerging market credit strategy. That's relative value as well. Both strategies we've been running for about a decade now.
Good afternoon, everybody. My name is Yusuf Alireza. I'm the co-founder, CEO, and CIO of ARP Global Capital. I spent 20 years at Goldman Sachs between New York, London, and Hong Kong. ARP Global Capital is a multi-asset, both private and public fund, managing me and my partner's capital and the capital of other families as well.
And I'm Jawad, Mian. I run a macro research business over here. The title is pretty broad, so we're going to cover the globe in our conversation. Let's start from home. And Fadi, I'll begin with you. UAE was the world's worst performing equity market last year. The region has lagged this year as well, which has been one of the best performing years for global equities. What's going on? How are you thinking about it? How are you positioned?
So yeah, I mean, if we want to talk about the region globally, we should not ignore Saudi Arabia, which is like the 800-pound gorilla in the region. And obviously this year has been a year for many events. Mind you, the geopolitical events that have been an overhang on the region from a pure perception perspective and flow of capital. You had also two flow events that are massive. The first one being MSCI and FTSE inclusion, which happened this year. And that brought tens of billions of dollars, about $25 billion in passive inflows into the region. And despite that, you still didn't have the runway that you expected from MSCI inclusion and FTSE inclusion. And now you have the Aramco one, which is also going to bring a lot of liquidity and just, let's say, realized gains into the Saudi market specifically. So I think we can also look at the region from a pure global perspective. So this year, Kuwait, just because gearing up for MSCI, has been the best performing market. Yeah, the biggest lagger has been the UAE, and then the second extent, Saudi Arabia, and then Egypt has probably done very well, thanks to also a lot of Egyptian pound appreciation as well. But I think the most important thing to look at is what is the title of the panel is the long term, and I think long term, where do you believe this region is going? And in this region, I think Saudi Arabia has a very big tailwind happening from a socio-economic perspective, and I think this is what a manager like ourselves, chasing volatility comes from change, and I think there's a lot of change in Saudi Arabia that hopefully ought to be monetized in the next few years.
So Saudis have experienced somewhat of a lost decade, if not a lost 15 years, because the index is at the same level as it was in 2004, 2005. So what will be the catalyst? Because even this year, it's underperformed oil even, right? So what will be, apart from the social economic changes, what will be the driving force to get foreigners more interested? Or will the local liquidity be enough to drive markets higher?
Well, yeah, I mean, you're right to look at it that way, but I think you should consider the changes as a great opportunity. The social changes, meaning the base effect in Saudi and the Saudi economy is going to change, and it's going to morph from a purely hydrocarbon-based economy to a much more, I would say, socially driven change, and productivity becoming the main factor for GDP growth as opposed to oil prices. So you mentioned that we have completely diverted from oil prices, and rightly so. I would have been very worried if Saudi is just still ticking like oil is ticking. And the whole point of 2030 was that diversion of saying social change bringing employment, whether Saudization or women insertion into the workforce, and ultimately that will trickle down into proper growth and healthy growth, as opposed to growth driven by the hydrocarbons, which could have a shelf life in the next 5 to 10 years. But I think the trigger is today an oil trigger. So Aramco's listing, obviously the headline for Aramco listing is a very important one. It's the largest company. People were betting on the 2 trillion. They didn't get the 2 trillion, but I think tomorrow is the first trading day, and I think we will get the 2 trillion tomorrow. Now, does it mean something? It just shows that this is the biggest company in the world listed in Saudi Arabia. It's actually not ticking with oil, because oil today is in 60s, WTI or Brent 60 to 64, and yet Aramco will get a 2 trillion valuation, but that will bring Saudi into the global map. So MSCI plus Aramco means a 3.5% weight in global in MSCI EM. If you add on top all the region, we're talking about 5.5% MSCI EM weight for the region. That's like top 5, top 6, just short of Brazil, but bigger than Russia, bigger than Mexico. So when you see allocators, that becomes on the map. And then you can forensically look at what are the changes in each and every country.
Mohammed, what about you? How are you thinking about investing in the region?
Sure. To answer this, maybe let me take a step back for a minute and just kind of explain how we look at things at Waha, kind of what framework we're going to use. In anything that we do, have been doing the last 10 years, kind of our framework is the following. We looked at 3 pillars. First one is trying to understand kind of where we are in the kind of economic cycle, both from a macro perspective, more importantly from a monetary policy perspective. The second one is we do a lot of bottom-up kind of analysis and work and kind of try and find the best way to express whatever thematic view we have. And the third one is to try to understand the liquidity and flow technicals around the markets or the underlyings that we invest in. And in that context, kind of globally, I think most people around the room are aware where we sit in the cycle. It's been 11-year expansion, late cycle. We've exhausted a lot of things on the monetary side, rates close to zero, negative in a lot of parts of the world. A lot of monetary expansion has taken place, probably has been the main or only game in town for a while now. What that has done in the context of the subject to the panel from a long-term return perspective is it has front-loaded a lot of those returns. I mean, this year, most of things kind of up kind of 15, 20%. Clearly, trees don't grow to the sky. You're front-loading a lot of those returns. And the medium to long-term expectations over the next 2 years across broad asset classes is such that your expected returns are going to be, by design, a lot lower than what you've seen over the last decade. So that's kind of the framework in which we think about kind of the markets globally. Now, within the context of the markets that we trade, in the context of that framework, what we're looking for typically is the following. Is things that might be out of sync from a macro perspective in terms of where they are in the cycle, from a monetary perspective to be out of sync as well, instead of being kind of having no kind of room whatsoever, still have like an easing room and kind of liquidity expansion room. And sometimes you find that, but you don't find ways to express it. So you're looking for ways to express those views. And lastly, you can have all of those, but if the liquidity is not there, you're not gonna see that kind of reflected in kind of price appreciation. We're gonna talk about some examples in due course. But coming back to your question now, which is how does MENA fit in that context? I mean, if you think about that framework, while, for example, we've seen a lot of monetary expansion globally, and kind of Europe, Asia, US have benefited from that, and bond prices have benefited from that. What you have seen in the region, in MENA specifically, is absolutely the opposite. Since 2014, a lot of the liquidity in the market is driven by oil prices. And that has kind of basically halved. And what you saw a shrinkage of that abundance of liquidity that we had previously. So instead of having liquidity expansion, we had liquidity shrinkage. The second thing is most of the other markets are interconnected, and part of the kind of either global world or global EM kind of framework. The region has not been historically, is at the verge of making it to EM indices, and as Fadi kind of mentioned, today, the region is somewhere around 5% of EM, going into probably 6 or 7% next year. Now, when you look at the global EM managers' weight of the region, that was close to 0%, now it's about 1%. So it is a massive underweight in the context of global portfolio. The market cap is increasing. In fact, it's probably going to double tomorrow from 1.5 trillion to 2 trillion through the Aramco IPO. And to give you an idea, to put some numbers on it, for global EM managers to be just market weight, that would mean another $60, $70 billion of inflows into the region. Fadi mentioned it's going to be top 5 kind of EM market. When you look at the top 4 or 6 or 7 EM markets, foreign ownership generally is somewhere between 20 to 30-something%. If we get to that level, and it's going to take years to get that, but if we get to that level, that means something close to 100 to $200 billion of inflows. So the point being, as you mentioned, for 15 years, when you look at the index level, the GCC and MENA went nowhere. It's very difficult to find markets like these globally. maybe South Korea, maybe Japan. But for 15 years, the markets have went nowhere. And pretty much going forward over the next few years, what you have is you have a put through global EM managers. They're going to have to kind of at least get market weight at some point. So from a liquidity perspective, we think there's a lot of support. From a bottom-up perspective, while the market at the index level hasn't done much, when you look at active managers, like Fadi, like ourselves, people have managed to kind of generate an alpha of 15, 20% a year in this market. So underneath the surface, there is a lot of bottom-up opportunities to generate alpha versus the underlying market. I'm just going to stop here.
I also think the last time you look at such a flat performance, like the worst decade in history, it was actually between 2000 and 2010 for the US. So we had the worst decade in history, which has been followed by 17% annualized returns, one of the best decades in history. So
absolutely. See, so and this is a template. It's not like in a region specific. If you look at the last 100 years, what you will find in all the markets, be it the US, be it Japan, be it Europe, you're going to find years where the index kind of front loads a lot of the compounding and years where it goes nowhere. And I think what you need to look for from a long-term perspective is those markets that for the last 15 years haven't gone anywhere. But clearly there has to be like a thesis around it, a liquidity thesis or like a macro thesis around it. And I think MENA is one of those markets. And specifically within that, and we can talk about it later, we think Egypt in particular is, for us, we see as a lifetime opportunity, and we can explain why later.
yeah. So coming to that point of a market that's been out of favor for many, many years, to the best performing equity market this year, which is Greece, best performance in over 20 years for the country. Yusuf, I know you've been involved in Greece. Any thoughts on what's happening there and if you continue to be involved?
Yeah, sure. So unlike my colleagues, and I think in some ways we're in the category of one, so we're based in Dubai, but we do very little investments in the region because both me and my partners spent our entire careers outside of the region. So we were both senior partners at Goldman Sachs, and so our experience is global markets, not regional markets, but our business is based in Dubai. And also, unlike most companies, we set up the business to manage our own money, not to manage third-party money. And so we defined the mandate of the business to be consistent with the way we've always invested our own capital. And we optimize the business to generate returns, not assets under management. So we don't, in that way, we have a very unique structure, which is being based here, but have the mandate to invest anywhere in the world, and very focused on generating returns, not assets under management. So as part of that mandate, we are thematic investors and long-term investors. So our public fund is a 3-year lockup fund because we want to invest for the medium term. And one of the benefits of having capital that's generational capital where you can invest for the long term is you can look at opportunities like Greece, which we did in February, like uranium, which we're looking at now, like a number of other distressed markets that come up every once in a while. And when we started looking at Greek banks in February of this year, in January, February of this year, and I had in the past looked at Greece multiple times. The banks had gone through multiple recapitalizations, and each one of them, in each one of them, more capital was lost, more market value was lost. By the time you came to February of this year, the largest bank in Greece, with $50 billion of asset per AS bank, had pretty much lost 99.5% of its market cap. Now, people always think, okay, well, that's a reason to look at something, but not necessarily a reason to invest in something. People think, okay, you've lost 99% of your capital, how much more can you lose? Well, you can still lose 100%, right? So you always have to keep that in mind, but we looked at the opportunity. So the largest bank in Greece, with almost 50 billion of assets, was trading not at 0.5 book value or 0.25 book value, it was trading at 0.05 book value. Now, if you think about banks in this region trading at 1.5 to 2 times book value. So you can buy the largest bank in Greece, you could have bought the largest bank in Greece with 50 billion of assets for 250 million euros. Now, the market's basically telling you that that bank is going bankrupt. And we had been watching the situation historically. I had watched it 3, 4 years ago, 5 years ago. And there's a few things. Our thesis was pretty simple. Our thesis was that for the last few years, there were significant headwinds in terms of the asset quality for the banks. If you have negative economic growth and you have asset prices falling, that's a very difficult situation for a bank to address its NPL situation. But in an environment where growth was picking up, so what was a significant headwind to the thesis became a significant tailwind to the thesis, because growth had picked up, and asset prices were starting to rise. So when we looked at Piraeus' balance sheet, we realized that a 1% increase in real estate prices translated into a $100 million increase in their book value, and people were missing that. They were missing the fact that the Greek government had come in very leftist, very revolutionary, very anti-Europe, but in the end had turned out to be Greece didn't leave the euro, and the government implemented probably some of the toughest reforms that any government has ever implemented anywhere in the world. So we started building a thesis. We felt that there was going to be a new government that comes in, which is very much pro-business. We felt that asset prices and growth were going to pick up, and effectively started feeling that Greece was almost a frontier-type market from a return perspective, without any of the FX risk, because it's part of the euro. Right? Where you can effectively, in many cases, get funding at 50 basis point and invest in very attractive assets. So we made our investment in a few of the banks. Piraeus Bank has now gone from 0.05 times book to almost 0.25 times book, so 5x. And many of the other banks have also appreciated. Then we moved our investment out of the, significant portion of our investment out of the banks into, they issued Tier 2 bonds. You're able to buy Tier 2 bonds at almost 10%. And that's with the Greek government 10-year bond at 1.5%. So we think the Greek government is going to get investment grade, is going to be upgraded to investment grade, and that these bonds, these Tier 2 bonds, will eventually trade at closer to 6%. At this point, we still think there's more upside in a few of the banks, specifically Piraeus, but we also think there's a very significant opportunity from an asset perspective in Greece, given that you basically have, you've had a 10, 15-year recession, 10-plus year recession, you now have economic growth, you now have asset price growth, you have capital flows coming in, and you have a very, very pro-business government.
I think that would be the next catalyst, would be the ECB starts buying Greek debt as well, right, if it gets upgraded. Speaking of reforms, Fadi, can you speak to some of the things that you're seeing on the ground in Saudi Arabia, speaking specifically on economic reforms?
Well, where can I start? There's a lot happening in Saudi, but I don't want to be doing propaganda for Saudi Arabia, despite calling Saudi home for the past 15 years. But I can tell you that the changes that happened for the past 1 year were not vindicated in the global press and even regional press. But I tell you, for someone living with his family in Saudi, that the changes that happened were immense and kind of daunting. So you look at the base effect of certain industries that were completely non-existent, call it entertainment, call it movie theaters, with penetration of 0%. So all of a sudden you just have entertainment parks kind of like flourishing from everywhere, movie theaters happening because it was just un-Islamic, quote unquote, back in the previous era. Women driving, just imagine the effect on motor insurance ultimately, on car driving, on car purchase, and so on and so forth. There's a lot happening, and the implication of these are quite immense, because for any manager looking at companies and operating in these fields are able to capture this entertainment component, the base effect, the bagger effect is immense. So you start from 0 penetration to go to 5% penetration. I'll give you gym, for example. So we have a gym chain in Saudi Arabia that had only male membership. And now that they just made female membership legal, so imagine just 0 penetration in gym chains going to 15, 20%. Global market is about 17%. Here, nearby in Dubai and Bahrain, you're talking about 8 to 10%. And all of a sudden, these guys are just selling gyms in a country where the purchasing power is way lower than that of the developed market, at $350, $400 a month for women gym for middle class. Just that, imagine the margin there. Yes, that's going to correct over time, but look at the margin of these businesses, look at the penetration uptick that you have. So the monetization of these social reform is quite impressive if you're able to capture it through some public companies operating in these fields. And so this is very good from a corporate earnings, but I think from a pure healthy economy moving forward, we're talking about a much healthier economy, much more independent than the economy that we had for the past 10 years, which was 20 or 30, dependent completely on hydrocarbons.
Mohammed, Egypt is one of your high conviction plays right now. Can you speak to what you're seeing over there?
Absolutely. So, leading up from Fadi's comment on Saudi, clearly, what's happening there is transformational. What I would say, though, is a lot of the great stories don't always kind of reflect themselves or be great investment opportunities, because sometimes a lot of that in the price, and it's really difficult to find kind of investment situations where a lot of things are working together, both from a story, from a top-down, from a liquidity perspective. And this leads me to talk about Egypt. It's one of those markets, again, as you mentioned, Jawad, earlier, for 15 years, in dollar terms, the index did not go anywhere. It's literally at the same level it was 15 years ago. And this is 100 million plus kind of population, kind of economy that grows, potentially grows about 5% plus. To take it back to that framework we use at Waha Capital, from the three kind of pillars. The first one on the macro side, this is an economy, an emerging economy, that's coming out from a situation where you had 2 changes of governments already, years of unrests, an IMF program for a number of years, which they're just exiting at the moment, on which they have over-delivered. It was one of the best executed IMF programs in EMs for the last probably 20, 25 years. So you go in from a macro perspective in a situation where Egypt had like debt to GDP in excess of 100 to probably somewhere around 70% next year. From an external situation where you had a lot of currency issues, repatriation issues, debt devaluation that happened took it around or probably below fair value, and you saw that rebalancing kind of take place in a very kind of beautiful way, I'd say. And today, their FX reserves in aggregate to GDP is something like 30%. In EM space, that's probably as good as it gets. It's a really kind of solid FX position to have. And clearly, potential growth is 5 to 6%, and the economy is quite likely to continue to grow at that pace for a significant period of time. Now, that's the macro part of it. Sometimes you get this, but you don't find ways to express it, or you find that it's already in the price. The way I describe it to people, this is India-type growth at probably a quarter or a third of the valuation, and very early in that cycle. From a bottom-up perspective, we spend a lot of time there, and we meet numerous companies whereby they've got exceptional management, clean balance sheet, extremely high return on invested capital. We're talking kind of 25 to 40, 50% in some instances, a long runway of growth, a lot of pricing power, and there is a huge pool of opportunities where you can deploy a meaningful amount of capital in that space from a bottom-up perspective. Now, all that's good and great, but sometimes these things take time to play out. And in the case of Egypt, I could have told you the same thing a year ago or 2 years ago, and the index still did not go anywhere. And that's why we need that pillar number 3. So we look at what's happening on the monetary side and on the liquidity side. On that space, last year, Egypt started easing rates from about 20%, and it's probably going to settle somewhere around high single digit at some point kind of next year. Again, to put that in perspective, what's been happening globally, we're still kind of early or mid-cycle on that easing. So very out of sync with what's been happening kind of globally. Typically, when you have that, the templates we've seen elsewhere in other EM markets like Brazil, some time ago, or India, is you get 2 things. You get the discount rate, which is much lower, so it should reflect, in theory, on your multiple expansion at some point, which hasn't happened yet, but it will, because it always does. And what it needs for it to happen, it needs the liquidity expansion. And probably what I just said, you probably heard it from a lot of people before, but the part that we really spend a lot of time doing and analyzing is this last part, is the liquidity. Egypt's central bank, for the last 3 years, they've been absorbing liquidity from the system. They've absorbed something close to 800 billion EGP through unorthodox open market operations. That's equivalent to something like 20% of GDP. For the first time, the central bank is indicating that they're going to start releasing that liquidity back. Inflation came from kind of 40%. I think to this morning's print was actually negative. We're going to go back to 5, 6, 7, 8%. So they're starting to release that liquidity back in the system. And we're expecting that release to be front-loaded. So that's the last catalyst, and I think as it plays out over the next kind of 1 or 2 years, we would not be surprised to see that kind of 15 years of absence of compounding, of going nowhere, and things trading below book, significantly below book, significantly below replacement value, and a lot of kind of quality compounding companies that you would pay 30 times, 40 times earnings for elsewhere are trading at probably 5 or 6 times earnings. We would not be surprised to see the same template play out in Egypt, whereby that market could do like a 3x or 4x as a market. Now, within that, you can still express it in a levered way that you can get potentially more than that. So the way we see it, when you look globally, it is very, very difficult to find a situation whereby you've got a confluence of the macro story, the monetary story, the bottom-up, and the liquidity all working together in a positive fashion to give you this kind of outcome. For us, it's probably once in a decade, maybe once in a lifetime. I'm not sure I'm going to see this again, but we're taking it very, very seriously. We're structuring a lot of things around it, and we're very excited about it, as well as I see some of our investors as well, and they're familiar with that thesis.
Yusuf, any situation that you're focused on now in the context of value and long-term, and given your flexibility with capital allocation?
Yeah, so like I said, we're still focused on Greece, and one of the opportunities we're looking at is to take one of the small banks private, where obviously Greece is part of the euro, so you can go out via deposit aggregators and raise deposits at 0.5% to 1%, and then invest in loans, commercial real estate loans at loan to value of 50% at 5, 6, 7, 8%. So there's still significant opportunities there. Another market that I have looked at on and off for a few years is the uranium market. Another market where, if you look at some of the miners, they've lost 99% of their capital, but you could have said that a year ago, and it wouldn't have been a good opportunity. So like I said, those are always opportunities where you should look, but doesn't mean that it's a good investment opportunity. But listen, you go back and you can look at what the event was that resulted in a very significant supply-demand misbalance, where a significant amount of demand was taken out of the market, and that's obviously the Japanese, the Fukushima situation, the Japanese earthquake, right? And that took a significant amount of demand out of the market, and that was the that was the event that that really rebalanced the market, and has resulted in what is now almost an 8-year bear market in that asset class. Now, the thesis is a simple one, which is everybody's very focused on renewables. I'm sure there's not many people in this room that would argue that renewables is not the way forward in terms of power supply. You look at solar, you look at wind. Solar is not only competitive to gas as a power source, it's competitive to coal as a power source. So there's clearly very few people will argue that there's going to be a shift to renewables. But as we all know, renewables is an intermittent source of power, and you need a base load. And if you believe that there's going to be a very significant shift away from traditional sources of power like gas and coal to renewables, then you have to solve for that base load. And the most environmentally friendly solution to that base load is nuclear, right? Current demand in terms of million pounds a year is about 190 million pounds. Supply is closer to 160. And if you just look at the plans that China has announced in terms of the number of reactors that they want to build, their demand alone could go up to 60, 70, maybe 90 million pounds a year, right? So currently, it's very difficult not to create to look at the supply-demand fundamentals and not think that there's going to be a significant supply shortage at some point over the next few years. The question, of course, is how do you structure the investment and what is the timing of the investment? But that's one that we think can be like Greece, a 5+X at some point.
As a final question, one of the reasons I struggle with long-term is if we were all sitting here in 2014, I don't think we would have predicted that this will be the longest US recovery or the bull market. Trump as president, 16 trillion negative yields, oil prices having averaged $100 a barrel for 3 years in a row, falling 26, and now close to 50, 60. Greece yields matching US yields. Like, we wouldn't have imagined any of this 5 years ago.
Greece yields below US yields.
Below US yields. So none of this is something that we would have imagined sitting here in 2014. So what is it about the next 5 years that you feel people will get wrong?
I think, can I?
Yeah, all of you, each of you.
From our side, I think, we recognize that it's very, very difficult to sit and say, well, this is what's going to happen over the next 3, 4, or 5 years. And by design, what we're living now, it's unique historically. And for anybody to say, the monetary experience is, we've never seen it before. Uncharted territory and the consequences of that, who knows? And that's why in anything that we do, what's been core to our investment and our investment thesis and a lot of things is margin of safety. So you're looking for those situations that have been out of favor, where there is a catalyst in the horizon, and where the skew in terms of payout is very compelling, and the downside is really limited. Like, tail I win, as I don't lose.
That doesn't answer the question. Are there any predictions over the next 5 years that people are not thinking of right now that would surprise people?
Yeah.
Listen, well, first of all, I think I'll make a prediction, and I don't think it's very surprising, but then I'll talk about one that would potentially be surprising. Listen, I think the traditional approach to investing, the traditional asset allocation, 40% bonds, 60% equities, based on a market distributed distribution, it is just going to be a very painful way to invest, right? With bond yields where they are globally, with multiples where they are globally, with technology basically disrupting industry. Historically, you could feel very safe investing in the Nokias, whatever, the GEs of the world, right? Every company is either going to be a disruptor or disrupted. And if you're in the disrupted, you're going to lose a lot of money. And if you're in the disruptor, you're going to make a lot of money. So that whole traditional approach to investing, at best, I think, over the next 5 to 10 years, is going to give you 3 to 4%, right? That's a prediction I feel comfortable making. I don't think it's out of... Listen, I think the big surprise is we've lived in a decade of US exceptionalism, right? We've been big investors, our biggest allocation has been US and then followed by China. We've stayed away from Europe except for Greece for many, many years. And Europe has everybody says US is expensive, US is expensive, but you know what? It continues to outperform, it continues to have the best companies, it continues to have the best equity performance. And I think, one of the things that we're really challenging ourselves for the first time in probably 10 years is the decade of US exceptionalism coming to an end? And are there better opportunities outside?
I predict peace in the Middle East, which should sort of lead to you guys doing really well with your MENA investments. And that's all the time we have for today. Thank you very much.